Look, I need you to pay very close attention to what I'm about to show you, because what just happened in the silver market over the past 48 hours is something most people completely missed. And if you're not positioned correctly right now, you could be leaving serious wealth on the table. Silver just hit 66,665 per ounce. Let me say that again because I want it to sink in. Silver touched 66,665. That's an all-time record high. Not since the Hunt brothers tried to corner the market in 1980 have we seen anything remotely close to this kind of price action. And here's what nobody's talking about. This isn't just another bull run. This is the beginning of something much, much bigger. You see, while everyone was focused on gold making headlines, silver quietly doubled in 2025. That's right, a 100% gain year to date. Gold went up 54%, which is impressive, don't get me wrong. But silver went up 100%. It literally doubled. And most mainstream financial media barely mentioned it until this week when it smashed through every resistance level like they weren't even there. Now, I know what you're thinking. Okay, silver had a good run. Time to take profits and get out, right? Wrong. Dead wrong. And I'm going to show you exactly why the smart money, the institutions, the people who actually move markets, are just getting started with silver. Because what's happening right now isn't speculation. It's not retail FOMO. This is a fundamental supply-demand crisis that's been building for years, and it's finally reaching a breaking point. Let me paint you a picture of what's really going on behind the scenes. Silver mine production has been declining. Not just this year, not just last year. We're talking about a multi-year trend of decreasing production. The easy silver has already been mined. The high-grade deposits are depleted. What's left requires more energy, more capital, and more time to extract. And here's the kicker. Even with silver prices doubling, mining companies aren't rushing to open new mines. You know why? Because it takes 7 to 10 years to bring a new silver mine online. 7 to 10 years. By the time they could increase supply, this opportunity will be long gone. Meanwhile, demand is absolutely exploding. And I'm not talking about investment demand, although that's surging too. I'm talking about industrial demand. Silver is the most conductive metal on Earth. It's irreplaceable in solar panels, electric vehicles, 5G infrastructure, and advanced electronics. Every single solar panel requires about 20 grams of silver. Every electric vehicle uses 2 to 3 times more silver than a traditional car. The global push toward green energy isn't slowing down, it's accelerating. And every single one of these technologies needs silver. Think about this for a second. China just announced they're doubling their solar capacity by 2027. The European Union has mandated that all new buildings must have solar panels by 2026. The United States is subsidizing EV production with hundreds of billions of dollars. This isn't speculation about future demand. This is locked in, guaranteed industrial consumption that's growing exponentially. And there's no substitute. They tried. Believe me, they tried to find alternatives. But nothing conducts electricity like silver. Nothing reflects light like silver. Nothing has the antibacterial properties of silver. It's irreplaceable. Now here's where it gets really interesting. The COMEX, which is the major exchange where silver futures are traded, is showing something absolutely unprecedented. The amount of physical silver available for delivery has dropped to critically low levels. We're talking about the lowest inventory levels in decades. At the same time, the number of contracts demanding physical delivery has skyrocketed. You see what's happening here? This is a classic supply squeeze setting up in real time. Let me explain how this works because this is crucial. Most silver trading happens on paper. Futures contracts, ETFs, certificates. It's all paper promises of silver. But increasingly, buyers are saying, no, I don't want a paper promise. I want the actual metal. And when you have more people demanding physical delivery than there is physical silver available, prices have to go up. It's not complicated, it's basic supply and demand. But the magnitude of this squeeze is something we haven't seen in modern markets. Central banks are watching this very carefully. And here's something that should make your ears perk up. While everyone focuses on central banks buying gold, they're also quietly accumulating silver. Not in the same quantities, obviously, but the trend is unmistakable. Why would central banks, who have access to the best market intelligence in the world, be adding silver to their reserves? Because they see what's coming. They understand that the paper silver market is built on a foundation of sand, and when it collapses, physical silver is going to be worth multiples of what it is today. Let me tell you a story that perfectly illustrates what's happening. Back in 2008, during the financial crisis, there was a brief moment when you literally could not buy physical silver at any price. The paper price said silver was $9 an ounce. But try to actually buy a silver coin? Dealers were out of stock. Premiums were 50%, 100%, sometimes 200% over spot price. The paper market said one thing, but the physical market told a completely different story. We're heading into a similar situation, except this time the fundamentals are 10 times stronger. You've got to understand the mechanics of what's happening in the COMEX. There are commercial traders, usually big banks, who short silver futures. They sell contracts promising to deliver silver they don't actually have, betting that prices will go down. It's been a profitable trade for years. But now they're trapped. Silver keeps going up, and they're sitting on massive short positions that are bleeding money every single day. At some point, they're going to have to cover those shorts. They're going to have to buy back those contracts. And when they do, it's going to add rocket fuel to a market that's already on fire. Here's what most people don't realize. The silver market is tiny compared to other commodities. The entire above-ground supply of investment-grade silver is worth maybe $50 billion. That's nothing. That's less than the market cap of many individual tech stocks. It would take just a small fraction of institutional money flowing into silver to send prices absolutely parabolic. And that money is starting to flow. Silver ETFs are seeing record inflows. Retail investors are buying physical silver at rates we haven't seen since 2011. But more importantly, institutional investors are finally paying attention. Now, let me pause here for just a moment because this is important. If you're sitting on $100,000 or more in retirement accounts, you need to understand how gold and silver IRAs work. I put together a comprehensive guide that breaks down exactly how you can get physical precious metals into your retirement account without triggering tax penalties. It's completely free, and you'll find the link in the description below. This isn't about speculation. This is about protecting wealth you've spent decades building. Definitely worth checking out if you're in that situation. All right, back to what's happening in the market right now. On December 16th, we saw something fascinating. Silver pulled back from its highs, dropping below $60.50 and losing more than 2.5% in a single session. The mainstream media immediately jumped on this. Silver bubble bursting, time to sell. But here's what they missed. This wasn't weakness. This was profit-taking after an absolutely historic run. And more importantly, the dip was bought immediately. Within 24 hours, silver was back above $63, and by the next session it hit new all-time highs at $66.65. This is classic bull market behavior. You get these sharp pullbacks that shake out weak hands, and then the trend reasserts itself even stronger. The people selling on that dip? They're going to regret it, because the buyers stepping in aren't retail investors chasing momentum. They're sophisticated players who understand the fundamentals and are using any weakness to accumulate more. Let's talk about what happened in 1980 for a minute, because there are some parallels, but also crucial differences. In 1980, the Hunt brothers tried to corner the silver market. They bought massive amounts of physical silver and futures contracts, driving the price from $6 to $50 in just a few months. But it was artificial. It was manipulation. And when the COMEX changed the rules to stop them, the price collapsed. What's happening now is completely different. This isn't one or two players trying to manipulate the market. This is genuine supply-demand fundamentals playing out across the entire global economy. In 1980, there was no industrial demand for silver like we have today. Solar panels didn't exist. Electric vehicles didn't exist. 5G networks didn't exist. The industrial applications that make silver absolutely essential to modern technology simply weren't there. Today, industrial demand alone is enough to absorb most of the annual mine supply. Add in investment demand, and you've got a recipe for sustained higher prices that aren't going to collapse like they did in 1980. Here's another angle most people aren't considering: the dollar. The US dollar has been the world's reserve currency for decades, But that's changing. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively working to reduce their dependence on the dollar. They're settling trade in their own currencies. They're talking about a BRICS currency backed by commodities. And guess what's on that list of commodities? Gold and silver. If even a fraction of global trade shifts away from dollars and into commodity-backed currencies, the demand for precious metals is going to explode. China understands this better than anyone. They've been accumulating gold for years, but they're also stockpiling silver. Chinese imports of silver have been steadily increasing, and they're not doing it for fun. They're doing it because they see the strategic value. Silver isn't just a monetary metal, it's an industrial metal that's critical to their technological ambitions. They want to dominate solar energy, electric vehicles, and advanced electronics. And to do that, they need silver. Lots of it. Now let's talk about what happened in 2011, because that's the last time silver really went on a tear. Silver hit $49 an ounce in April 2011, driven by fears about the financial system after the 2008 crisis. But then it crashed, falling all the way back to $14 by 2015. A lot of people got burned, and they're understandably nervous about buying silver at these levels. But here's the critical difference. In 2011, the fundamentals weren't there. It was purely a fear trade. People were buying silver because they were scared, not because there was a genuine supply shortage or surging industrial demand. Today we have both. We have the fear trade, yes. People are worried about inflation, about government debt, about the stability of the financial system. But we also have rock-solid industrial fundamentals. We have declining mine production. We have surging demand from technologies that didn't exist in 2011. This isn't just a fear trade that's going to evaporate when sentiment changes. This is a structural shift in the silver market that's going to persist for years. Let me give you some specific numbers to drive this home. Global silver mine production peaked in 2016 at about 900 million ounces. By 2024, it had fallen to around 830 million ounces. That's a decline of 70 million ounces per year. Meanwhile, industrial demand has grown from about 500 million ounces in 2016 to over 600 million ounces in 2024. You see the problem? Production is falling while demand is rising. That gap has to be filled somehow, and it's being filled by drawing down above-ground inventories. But those inventories aren't infinite. At some point, they run out. And when they do, prices are going to go absolutely vertical. The solar industry alone is projected to consume 150 million ounces of silver per year by 2027. That's nearly 20% of total global production going to just one industry. Add in electric vehicles, 5G infrastructure, medical applications, and traditional uses like jewelry and silverware, and you're looking at total demand that far exceeds supply. The only way to balance that equation is through higher prices, much higher prices. Here's something else that's flying under the radar: the energy cost of mining silver. Most silver is actually a byproduct of mining other metals like copper, lead, and zinc. As energy costs rise, which they have been, the economics of mining these base metals becomes less attractive. Mines shut down or reduce production. And when they do, silver production falls as a consequence. We're seeing this play out in real time. Mines in Peru, Mexico, and China, the three largest silver-producing countries, are all facing higher energy costs and regulatory challenges. This isn't going to reverse overnight. Now, I want to address something that skeptics always bring up. But silver crashed before. What makes this time different? Fair question. And the answer is everything. The 1980 crash was caused by manipulation and rule changes. The 2011 crash happened because the fundamentals weren't there to support the price. But today we have genuine supply constraints meeting explosive demand growth. We have central banks diversifying away from dollars. We have a global energy transition that requires massive amounts of silver. We have geopolitical tensions driving safe haven demand. All of these factors are converging at the same time. Think about the psychology of what's happening right now. For years, silver has been the forgotten metal. Gold got all the attention. Bitcoin got all the hype. Silver was boring. It traded in a range between $15 and $25 for nearly a decade. Investors gave up on it. But that long consolidation period did something important. It built an incredibly strong foundation. All the weak hands got shaken out. all the speculators left. What remained were long-term holders who understood the fundamentals. And now, as the price breaks out, those same investors who gave up are watching in disbelief. Here's what's going to happen next, and I'm going to be very specific about this. Silver is going to consolidate around these levels for a bit. We might see it pull back to $60 or even $58. The media will call it a top. Short-term traders will take profits, but that consolidation is going to be brief because the underlying fundamentals haven't changed. Industrial demand isn't going away, supply constraints aren't going away, and when silver breaks out above $70, which I believe it will in the first quarter of 2026, we're going to see a move that makes this recent rally look tame. The target that serious analysts are talking about isn't $70 or $80. They're talking about $100, $150, even $200 per ounce. Now, I know that sounds crazy. Silver at $200? But let me put it in perspective. If silver just matched its inflation-adjusted high from 1980, it would be trading at over $140 today. And remember, the fundamentals today are far stronger than they were in 1980. So $200 isn't some pie-in-the-sky fantasy. It's a realistic target based on supply-demand dynamics and historical precedent. Let me tell you about what's happening in the physical market right now, because this is where you really see the stress. Dealers are reporting unprecedented demand for physical silver coins and bars. Premiums, which is the amount you pay above the spot price, have been climbing steadily. In some cases, you're paying $5 to $8 per ounce over spot just to get physical silver. That tells you something important. There's a disconnect between the paper price and the physical price. The paper market says silver is $63, but if you actually want to hold it in your hand, you're paying $70 or more. This premium expansion is a warning sign that the paper market is losing credibility. More and more investors are saying, I don't trust paper promises, I want the real thing. And as that trend accelerates, the paper market is going to come under increasing pressure. At some point, the paper price is going to have to catch up to the physical price. And when it does, we're going to see a repricing event that shocks the financial world. Now, let's talk about the role of silver in a diversified portfolio, because this is where a lot of people get it wrong. Silver isn't a get-rich-quick scheme, it's not a lottery ticket, it's insurance, it's a hedge against currency debasement, against inflation, against systemic risk. But here's the beautiful thing about silver right now. It's insurance that's actually appreciating in value. You're protecting your wealth while simultaneously growing it. That's a rare combination. The smart money understands this. They're not putting 100% of their portfolio into silver. They're allocating 5%, 10%, maybe 15% to precious metals as a hedge. But that allocation is becoming increasingly important as we move into an era of unprecedented monetary experimentation. Central banks are printing money at rates that would have been unthinkable a decade ago. Government debt is exploding. The purchasing power of fiat currencies is eroding. In that environment, hard assets like silver become essential. Here's a scenario I want you to consider. What if the paper silver market actually breaks? What if the COMEX runs out of physical silver to deliver against contracts? It's not as far-fetched as it sounds. The inventories are at historic lows. The demand for physical delivery is at historic highs. If we get a rush of contracts standing for delivery all at once, the exchange might not be able to fulfill them. And if that happens, the price of physical silver is going to decouple completely from the paper price. We could see physical silver trading at $100 while the paper price is still at $70. That's the kind of dislocation that creates generational wealth for people who are positioned correctly. Let me give you another historical parallel. In the early 2000s, there was a similar situation developing in the uranium market. Demand was growing, supply was constrained, and inventories were being drawn down. For years, nothing happened. The price stayed flat. But then, suddenly, uranium went from $20 per pound to $140 per pound in just 3 years. It was a supply squeeze that caught almost everyone off guard. The people who recognized it early made fortunes. The people who waited until it was obvious paid top dollar. Silver is setting up for a similar move, except the fundamentals are even stronger. Think about the geopolitical dimension of this for a moment. We're living in an increasingly multipolar world. The United States is no longer the unquestioned hegemon. China is rising. Russia is asserting itself. The Middle East is in flux. In this environment, Countries are looking for ways to protect their wealth that don't depend on the goodwill of the United States. Gold and silver fit that bill perfectly. They're no one's liability. They can't be sanctioned. They can't be frozen. They're the ultimate neutral asset. And as geopolitical tensions rise, which they inevitably will, the demand for these neutral assets is going to increase. Now, I want to address the elephant in the room. Volatility. Yes, silver is volatile. It can swing 5% or 10% in a single day. That scares a lot of people. But here's what you need to understand. Volatility is the price you pay for opportunity. If silver just went up in a straight line with no pullbacks, everyone would own it, and there would be no opportunity left. The volatility is what creates the opportunity for those who understand the fundamentals and have the conviction to hold through the swings. Let me tell you what I'm seeing from institutional investors right now. They're not buying silver because they think it's going to double next week. They're buying it because they think it's going to be worth multiples of the current price over the next 5 to 10 years. They're taking a long-term view based on structural trends that aren't going to reverse. The energy transition isn't going to reverse. The decline in mine production isn't going to reverse. The loss of confidence in fiat currencies isn't going to reverse. These are mega trends that play out over decades, not months. Here's something that should really make you think. The gold to silver ratio. Historically, this ratio has averaged around 15 to 1. That means it took 15 ounces of silver to buy 1 ounce of gold. Today, even after silver's massive rally, the ratio is still around 35 to 1. That means silver is still historically cheap relative to gold. If that ratio reverts to its historical average, and there's good reason to think it will, silver has to either double from here or gold has to get cut in half. Which do you think is more likely? The answer is obvious. Gold isn't going to get cut in half. Central banks are buying it. Geopolitical tensions are rising. Inflation is persistent. Gold is going higher, which means silver has to go much, much higher to bring that ratio back into balance. This is basic math, but it's math that most investors aren't doing. They see silver at $66 and think it's expensive. But relative to gold, relative to its historical average, relative to its industrial fundamentals, silver is still cheap. Let me paint you a picture of what the next 12 to 24 months could look like. We're going to see continued volatility. There will be pullbacks that test your conviction. The media will declare the rally over multiple times. But underneath all that noise, the fundamentals are going to keep improving. Industrial demand is going to keep growing. Mine supply is going to keep declining. Inventories are going to keep falling. And at some point, probably sooner than most people expect, we're going to see a price spike that makes this recent move to $66 look like a warm-up. When that happens, and I believe it will, the people who position themselves early are going to be rewarded handsomely. The people who waited for confirmation, who waited for the mainstream media to tell them it was safe to buy, are going to be buying at much higher prices. That's how markets work. The early movers get rewarded. The late movers pay a premium. The question is, which group do you want to be in? Now, I'm not saying you should rush out and put your entire net worth into silver. That would be reckless. What I am saying is that if you don't have any exposure to silver right now, you're missing one of the most compelling risk-reward opportunities in the entire financial market. Even a small allocation, 5% or 10% of your portfolio, could make a significant difference in your overall returns over the next few years. Here's the bottom line, and I want to be crystal clear about this. What just happened in the silver market isn't the end of the story. It's the beginning. Silver hitting 66.65 isn't a top. It's a breakout. It's the market finally recognizing what the fundamentals have been screaming for years. Supply is constrained. Demand is exploding. The paper market is under stress. And the smart money is positioning for a move that could redefine wealth for a generation. You have a choice to make right now. You can dismiss this as hype. You can wait for more confirmation. You can tell yourself that you'll buy on the next dip. Or you can recognize that we're in the early stages of a historic move and position yourself accordingly. The opportunity is right in front of you. The question is, are you going to take it?